Do you really know how changing markets will affect your retirement portfolio? Hi, my name is Greg Parker. Welcome to our Retirement Basics series called What Your Advisor Isn't Telling You. Today, we're going to be talking about what your advisor isn't telling you about market risks in retirement. Folks, the simple fact is most investors don't realize how changing markets will affect a retirement portfolio over time. Markets go through secular changes or cycles from time to time. And the fact of the matter is, even most investment professionals do not understand how changing market risks could affect a retirement portfolio. It's interesting when we talk about risk, most professionals in the industry want to talk about risk in terms of standard deviation, correlations, or diversification. What I've come to realize talking to most clients in retirement is that there's only one way that you can really define risk, and that is, what are the odds that my investment portfolio goes down in value? The most famous decline in value in recent history has been the financial crisis from October of 2007 to March of 2009, where the S&P 500 index declined 63% from beginning to end. So for example, a retirement portfolio of $1 million invested in the S&P 500 would have declined down to $370,000. Now, I know most of you would never invest 100% of your retirement portfolio in an index like the S&P 500, but even during the financial crisis, we saw balanced portfolios, the famous 60-40 portfolio with 60% in stocks and 40% in bonds, decline nearly 35% during that same time period. Hasn't there got to be a better way to understand when markets are going through changing risk elements and be able to adjust a retirement portfolio? Well, I'm glad you asked. If we think back to some of the smartest investors of all time, we've been given enough guidance to understand that the important part of managing a retirement portfolio is not focusing on those areas of the market that should go up the most in the future, but instead focusing on the market risk. Folks, Benjamin Graham, mentor to Warren Buffett, said the essence of investment management is the management of risk, not the management of returns. So how do we look at risk? When we look at markets today, is there a way that we can measure market risks? Well, I'm glad you asked. When we look at market risk at Engrave Wealth, we are studying risk across a variety of market sectors, looking at a variety of different investment asset classes, and understanding that risk can be portrayed differently based on matters of time. For example, most recently, when we want to look at market risk, we can study the difference between U.S. equities, non-U.S. equities, resources and materials, real estate, bonds, gold, energy, and the list goes on. But let me focus in for just a moment on how we measure market risk on a day-to-day basis. Looking at our market risk indicators from a recent snapshot, we were looking at long-term risk measurements for U.S. equities. Now, we do that by looking at broad indexes, not the S&P 500, not the Dow Jones, not even the NASDAQ 100. When you want to get a broad look at markets, it's best to start with an index like the Russell 3000. The Russell 3000 is a simple index that measures the 3,000 largest companies in the U.S. marketplace, from largest to smallest. You're looking at market capitalizations from as big as Apple, Google, and Microsoft, all the way down to companies that are merely worth tens of millions or just low hundreds of millions of dollars. That index is a very broad representation of small companies, mid-sized companies, large companies, and what we now call mega companies. The Russell 3000 index can be measured in a variety of ways. We apply a measurement of 7 different tools every single day to the Russell 3000 so that we can better understand the inclination that the index is in, and then compare it to historical relevant periods. For example, when we look at the Russell 3000 today, many of the things that we see today look like various times in the past. My confidence in the quality of this particular indicator measure comes because over the last 20 years, the indicator has done a healthy job of showing us times when the market is seeing rising risk levels and a period where the market is seeing lower risk levels. When we see an indicator value today of 40 on the Russell 3000 index, which is benchmarked between 0 and 100, that has been consistent with prior periods of time where indexes experienced market declines and we saw higher risk levels in markets, both in October of 2000 as well as January of 2008. But we also saw higher risk levels in 2011 and 2016. They didn't look exactly the same as the financial crisis or the dot-com bubble, but they were significant enough that it required making changes to retirement portfolios. Understanding the significance of a long-term snapshot on the Russell 3000 and understanding where market risks lie today helps us to know how to adjust client portfolios in the face of changing markets. But let's not stop with just one measure. Let's go on and look at a similar type of time frame on another part of the index. Instead of looking at the broad Russell 3000 index, let's zero in now on the individual sectors that make up the broader index. If you break down the Russell 3000 index, you can find 36 subsectors or industry groups that trade within the Russell 3000 index. By applying the same basic measurement tools to each individual sector, we can also get a representation of how things are changing on a shorter time cycle. Looking at those current sectors today, we would see that 28 out of 36 sectors are actually reflecting lower risk and higher reward opportunities, even though the longer term picture is one of higher risk. Folks, understanding the significance of looking at market risks in different timeframes and across different parts of the market helps to reveal things that we might not otherwise see. Understanding how the short-term indicators can slowly work their way into longer-term measures is key to adjusting client portfolios. Finally, when we look at these changes, the frequency of changes can tell us a lot about the markets. While earlier in 2022 saw a high degree of change in the indicator, what we've noticed over the last 4 months is much fewer or a lot fewer changes in the indicator itself that actually help us to see markets are starting to stabilize a bit. Does it mean we're out of the woods entirely for market risk? Certainly not, but it is pointed to changes in trends that can be very helpful when changing portfolios. Finally, let's not just focus on market sectors and indexes, but let's look at the asset classes where you actually invest. The balance of strength signal we call the BOSS indicator is also reflecting a current positive signal, but it's because it is actually measuring various asset classes that we might invest in and comparing them to the demand for cash. When risk levels decline, other investment asset classes will rise above cash in the priority of investments. Currently, only 2 individual asset classes are sitting above cash when it comes to measuring risk. If the markets were to continue to improve, we would expect to see additional asset classes climbing above the demand for cash as an investment alternative. Folks, when you put them all together, the bottom line is that these indicators help us to see coincidental periods where markets tend to deliver better than expected gains. For example, over the last 20 years, anytime we've had an incidence of 3 positive indicators, that has coincided with very favorable times for investing for retirement. When we think about over the last 20 years, nearly 50% of all market days have actually seen 3 positive market indicators. What that means is that the S&P 500 has a compound annual growth rate, or CAGR, at the top of your screen of better than 17% per year. Folks, in other words, when the sun is out, we need to be making hay in the portfolio. This is when risk levels are lower, rewards are greater, and the idea of being able to invest for good long-term gains is a great opportunity. However, as the market sentiment begins to change and risk levels rise, we expect to see those indicators change. And when we decline from 3 positive down to 1 or 2 positive and eventually to no positive indicators, very obviously we expect that the market risk sentiment will change as well. What we see very clearly is that in periods of time when there have been 3 negative market signals, we very clearly don't see that often, only 6% of all days over the last 20 years. However, when that is the case, the S&P 500 compound annual growth rate drops to a nearly negative 50%. Folks, the bottom line is that risk levels have now risen to the point that it's difficult to earn returns on any part of the market. And it certainly means that adjusting your portfolio for retirement is a necessity. If you've never had the opportunity to look at market risk this way and the way that it affects a portfolio, we'd like to invite you into a conversation for a free portfolio analysis and a free retirement evaluation so that you can know better how changing market effects can impact your retirement portfolio. This may look different to you, and I understand if it does. We've worked with retirement investors for many years and have understood the anxiety that comes with living in retirement and not having a working income, living off portfolio income and seeing portfolio values adjust. Folks, as a result, we have created a fee-only fiduciary planning process that is designed to help you minimize the taxes that you pay in retirement, receive the income that you're going to need after retirement, especially if that income is a little bit more in the earlier years of retirement, and protect the investment portfolio from significant market downturns. Folks, at Engrave Wealth Partners, this process is a commission-free, fee-only process that we will help you build out a plan that works best for you. If you've got questions about retirement, like, does my portfolio have too much market risk right now? Or how much am I actually paying in commissions and fees? And what are these Roth conversions I keep hearing about for tax planning? And then what about taxes when it comes to RMDs? These are questions that we address for absolutely no charge in our retirement optimization program. Folks, we will build a free retirement analyzer for you that looks at these questions and gives you the answers that you need by simply looking at your current tax situation as well as your current retirement investments. All of that is done with a no obligation, free look, and we will schedule time to meet with you either over Zoom or in our office to be able to share that plan with you so that you can know exactly what your retirement portfolio looks like. Folks, if you'd like to get started, simply go to our website at engravewealth.com, click the button to start your free retirement analysis. We'll collect some basic information and be in touch with you to schedule a time to discuss and review your retirement portfolio. I hope this is helpful, folks. Please feel free to share. We'd love to visit with you. Please reach out and we'll be glad to schedule some time. Have a great one.